Welcome to the Daily Insights That Matter. We begin today's DITM by talking about RBI's rate hike of another 50 basis points. Now, in line with the market expectations, the Reserve Bank of India hiked the repo rate by another 50 basis points today, stepping up its fight against the sustained above target retail inflation levels. Now, this is the fourth straight increase in the current cycle as the repo rate now stands at 5.9%. Now, despite the fact that the RBI had raised key interest rates by 140 basis points before today's announcement in this financial year, the inflation remains elevated due to large supply shocks, spillovers from the challenging global conditions, and improving demand. Now, with an inflation print of 7% for the month of August 2022, the CPI continued to remain above RBI's upper margin of 6% for the 8th consecutive month. Now, the government has mandated the central bank to maintain retail inflation at 4% with a margin of 2% on either side for a 5-year period ending March 2026. That said, the RBI has retained the CPI inflation forecast at 6.7% for FY23. Now, while domestic recovery remains broad-based as seen in the high-frequency data like the bank credit growth, the PMI services and manufacturing expansion, the rising GST collections, etc., risks emanate from global economic outlook which continues to remain bleak. Hence, the RBI has also trimmed down the GDP growth forecast to 7% as against the initial forecast of 7.2% growth. Now, while the MPC retained its current stance of remaining focused on the withdrawal of accommodation, it is important to note that the governor didn't hint at a neutral stance yet. Instead, Shaktikanta Das ji chose to stick to the calibrated withdrawal to highlight the fact that the MPC remains hawkish on the overall policy approach. Now, overall, the policy was largely on the expected lines. Taming inflation and ensuring the macroeconomic stability remains the key priority area, with RBI citing strong domestic recovery. Now, the reluctance of the RBI to change the stance from withdrawal of accommodation indicates that more monetary tightening is likely to be in the pipeline going forward. Now, India's current account deficit in the April to June quarter stood at $23.9 billion or 2.8% of the GDP. Now, this is much higher than the $13.4 billion or 1.5% of GDP as seen in the previous quarter of January to March. Now, a country experiences a current account deficit when the value of its imports of goods and services and other expenditure exceeds the value of its exports of goods and services. Now, a trade deficit is normally the largest component of a current account deficit. Now, with high trade deficit, India's current account deficit is under pressure. The rise in the current account deficit was due to the widening of the trade gap to $68.6 billion from $54.5 billion as seen in the previous quarter, along with an increase in the net outgo of investment income payments. Now, India has faced upward pressure on its import bills in 2022 because of Russia's invasion of Ukraine in late February, which led to a sharp rise in the prices of commodities across the globe. Now, as the trade deficit keeps expanding month on month, pressure is building on the rupee since many more dollars are going out than coming in. This causes the rupee to weaken or depreciate while strengthening the dollar. Now, while the trade deficit expanded, service exports and private transfer receipts registered a healthy growth. Now, economists believe that the current account deficit could touch 3.5% of the GDP this fiscal year as compared to the 1.2% in the previous fiscal year. However, this is still lower when compared to the 4.8% levels seen in 2011-12 and the 4.2% levels seen in the year before that. Additionally, India's forex reserves are just a tad below $545 billion but are much higher than the $300 billion seen in 2011-12 and 12-13. Now, we could also see some moderation in the current account deficit due to the softening in commodity prices in the near term and an increase in exports, especially the service exports, in which India is more globally competitive. Overall, while the trade deficit prints could further moderate in the near term, there is a considerable uncertainty around the trade and the current account deficit. So, what does all of this news mean for you? Yes, the inflation still remains above the upper tolerance of RBI of 6%. However, the forecasts provide a positive outlook with the inflation falling below the 6% levels from the fourth quarter of this fiscal year. Yes, the GDP forecast has been down revised, but the down revision is not from a 7% to a 4 or a 5%. The down revision is from 7.2% to 7% only. And by the way, that is still the highest globally. That said, the 50 basis points increase in the repo rate is in line with the expectations and is already factored in the current market scenario. Hence, this will have an indirect neutral impact on you. While the current account deficit has increased to 2.8% levels, it is still below the expectation of 3% levels. Going forward, we believe that India won't be adversely affected as we have ample foreign exchange reserves to withstand pressure and external challenges. Hence, this will have an indirect neutral impact on you as well. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.